Carnival Cruise reported quarterly financial results, and there were some important items that investors should consider. Of course, I've had Carnival stock rated as a buy all year, and I'll update this recommendation in this video, let you know what I think about the company after evaluating the latest quarterly results. Of course, before diving into these current results with the cruise ship industry, it's important to remember during the pandemic, this industry was absolutely devastated. There was a big question mark if most or any of these cruise ship companies would survive in their shape that they were in prior to the pandemic. Carnival surprisingly came out of that and is now thriving. So despite having the cruise ships shut down for many, many months, surpassing even a year in some areas, the company survived. But there were certain changes, including a much larger debt balance. So it's important for the company to generate profits and cash flow more so than ever. So this quarter, they achieved an all-time high of net profit of $2 billion. That's really impressive, surpassing their pre-pandemic benchmark by nearly 10%. So this company now is generating more profit than it was before the outbreak. That's impressive, especially because now they have a lot more debt and a lot higher interest expense, as the management team notes here. They have nearly 600% increase in net interest expense compared to 2019 on a unit basis. The debt levels are even more meaningful because the company borrowed this money at a time of desperation when their cruise ships were shut down and they were bleeding billions of dollars. Imagine going to a lender in that type of situation. Do you think the lender is not going to try and charge you super high interest rates? Of course they are, and they did. And so Carnival borrowed nearly triple. So before the pandemic, it had roughly $10 billion in debt, and that nearly tripled to $30 billion in debt in the aftermath of the pandemic. So it borrowed an incremental $20 billion at very, very high interest rates in desperate situations. And so this profit the company's earning is helping them pay down that debt, the highest cost debt, and thereby lower this interest expense, which then increases the cash flow, and they can have a positive virtuous cycle for many, many years as they pay down this debt. It'll take them time. They're not going to be able to pay down this debt in 1 year or even 2 years. It's going to take them time, and they're heading in the right direction. Click the link below to watch the full video.